Between 1986 and 1995, approximately 1,000 savings and loan institutions in the United States failed, at an estimated total cost to the federal government and to depositors of approximately $160 billion, the largest financial system bailout in American history up to that point. The physical legacy of the savings and loan crisis is visible today in every major Sunbelt metropolitan area. Office parks built between 1982 and 1989, whose construction was justified by financial models that the deregulated savings and loan industry had financed on the basis of optimistic absorption projections, and whose vacancy rates at the time of the industry's collapse documented the specific mechanism by which the combination of deregulation, federal deposit insurance, and the savings and loan industry's specific incentive structure had produced one of the most consequential episodes of commercial real estate overbuilding in American history. The forensic entry point for this case is not the financial mechanics of the savings and loan crisis, which have been extensively documented in the academic and regulatory literature. The forensic entry point is the architecture, the specific physical form that the crisis took in the built environment of Sunbelt America, and what that form reveals about the relationship between financial incentives, regulatory frameworks, and the systematic production of commercial real estate that the market did not need and could not absorb. The Garn-St Germain Depository Institutions Act of 1982 deregulated the savings and loan industry, allowing institutions that had been restricted to residential mortgage lending to invest in commercial real estate, junk bonds, and other higher-yielding assets. The simultaneous maintenance of federal deposit insurance meant that the depositors whose funds these institutions were investing in commercial real estate faced no personal risk from the investment's failure. The federal government guaranteed their deposits regardless of what the institutions did with the money. That combination, deregulation of investment authority combined with maintained federal deposit insurance, created the specific incentive structure that produced the buildings. The savings and loan crisis is documented in the federal bailout records. The architecture it produced is documented in the suburban office parks of Phoenix, Dallas, Houston, Atlanta, and Los Angeles. This case file reads both records simultaneously. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure, the specific mechanism by which the deregulated savings and loan industry produced commercial real estate overbuilding at the scale that the crisis documents is one of the most precisely understood examples of how incentive structures determine investment behavior in the financial system. Before 1982, savings and loan institutions were restricted to residential mortgage lending, a category of investment whose risk characteristics were well understood and whose returns were modest but predictable. The institutions competed for deposits by offering interest rates regulated by federal ceilings, and their lending was correspondingly restricted to the residential mortgage market. The inflation of the late 1970s had driven market interest rates above the federal ceilings, creating a deposit outflow from savings and loan institutions to money market funds that were not subject to the same rate restrictions. The industry's response was to lobby Congress for deregulation, arguing that the competitive disadvantage the rate ceilings created was threatening the industry's existence. Congress's response was the Garn-St Germain Act of 1982, which eliminated the rate ceilings and allowed savings and loan institutions to invest in commercial real estate, direct equity investments, and other higher-yielding assets. The covenant that Congress had not read carefully enough was the one embedded in the combination of deregulation and maintained deposit insurance. When the federal government guarantees deposits, regardless of how the institution invests those deposits, the institution's management faces an asymmetric incentive structure. The upside of successful investments accrues to the institution's owners and managers, while the downside of failed investments accrues to the federal government and ultimately to taxpayers. That asymmetry produces the specific behavior that the savings and loan crisis documented: aggressive investment in high-yield, high-risk commercial real estate at valuations and absorption projections that the market fundamentals did not support. because the institution's management captured the upside while the federal deposit insurance absorbed the downside. Every commercial real estate project financed by a deregulated savings and loan institution in the Sunbelt between 1982 and 1989 was a bet whose potential profits accrued to private parties and whose potential losses were insured by the federal government. At what point does the combination of financial deregulation and maintained government insurance guarantees become a subsidy for speculative investment at taxpayer expense? Leave your analysis in the comments below. The appraisal methodology that produced the commercial real estate valuations supporting the savings and loan industry's Sunbelt lending shared the foundational error this channel has documented across its archive, but expressed it through a market-specific dynamic that the deregulated lending environment had created. The treatment of the industry's own lending activity as evidence of market demand rather than as evidence of the industry's incentive to lend. The office parks and commercial developments that savings and loan institutions financed across the Sunbelt during the 1982 to 1989 period were appraised on the basis of market absorption projections that treated the available financing as a proxy for available demand, assuming that the developments would be leased and occupied because the financing existed to build them rather than because the market had demonstrated demand for the space they would provide. That circular reasoning was not unique to any individual appraisal. It was the systemic product of an environment in which the availability of financing had substituted for market analysis as the primary input in the development decision. The savings and loan institutions' incentive to deploy deposits in high-yield commercial real estate investments meant that financing was available for any commercial real estate project that an appraiser was willing to value at a level that supported the loan amount. The appraiser's incentive to produce appraisals that supported loans meant that appraisals were produced that treated the available financing as confirmation of the market demand that would eventually justify the development. The Resolution Trust Corporation's eventual liquidation of the assets that the failed institutions had accumulated documented, with specific geographic and property type precision, the magnitude of the absorption projection error. Office parks with 10 and 20% occupancy at the time of the RTC's acquisition, retail centers without anchor tenants, industrial parks without industrial users. The appraisals had been accurate representations of the development opportunity in a market where financing was unlimited and demand was assumed. They were inaccurate representations of the development opportunity in the market that actually existed. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The Resolution Trust Corporation, created by the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, was the federal agency responsible for managing the liquidation of the real estate assets accumulated by failed savings and loan institutions. The RTC's asset portfolio at its peak included approximately $400 billion in assets across every real estate category and every major American metropolitan market, with the highest concentrations in the Sunbelt markets where the savings and loan industry's commercial real estate lending had been most aggressive. The RTC's liquidation process produced a forensic record of the savings and loan crisis's physical legacy that no other source provides. The specific properties, their acquisition costs, their vacant or partially occupied status, and the prices at which they were eventually sold in the market that the crisis had created. The institutional denial embedded in the savings and loan crisis was distributed across every level of the financial and regulatory system that had allowed the crisis to develop. The savings and loan institutions' management had denied, through the approval of loans at valuations that the market absorption data did not support, that the commercial real estate investments they were making were speculative rather than prudent. The federal regulators had denied, through their delayed and inadequate response to the industry's deteriorating asset quality, that the deregulated savings and loan industry's lending practices constituted a systemic risk that the Federal Deposit Insurance Fund was absorbing. The appraisers had denied, through their production of appraisals that treated financing availability as market demand, confirmation, that their professional independence from the lending institutions whose loans they were supporting was compromised by the incentive structures that the deregulated environment had created. The architects and developers had denied, through their continued production of commercial real estate for which the savings and loan industry's financing was available, but the market's absorption capacity was insufficient, that the financial incentives driving the development pipeline were divorced from the market fundamentals that would eventually determine the development's commercial viability. The buildings are the physical record of all of those denials, stacked on top of each other across the Sunbelt suburban office parks. The savings and loan crisis's physical legacy across Sunbelt America is not entirely a story of permanent vacancy and stranded investment. The commercial real estate developed during the 1982 to 1989 period has, in many cases, been eventually absorbed by the market growth that the absorption projections had assumed would arrive more quickly than it did. Phoenix, Dallas, Houston, Atlanta, and Los Angeles have grown substantially since the late 1980s. And much of the commercial real estate that the Resolution Trust Corporation sold at cents on the dollar has appreciated significantly in the subsequent decades. The investors who acquired RTC assets at distressed prices generated the returns that the original savings and loan industry's lending had promised without producing. The geographic distribution of the savings and loan crisis's physical legacy, concentrated in Sunbelt markets whose long-term growth trajectories proved to be substantially as projected, means that the crisis ultimately produced commercial real estate in markets where it would eventually be needed, at a timing mismatch measured in years rather than in decades. What the savings and loan crisis architecture reveals in the context of this channel's 56-case archive is the specific mechanism by which regulatory failure produces physical infrastructure. When financial incentives and government insurance guarantees combine to make the production of commercial real estate profitable for developers and financiers regardless of market absorption, the market produces commercial real estate regardless of market absorption. The buildings were not accidents. They were the predictable output of a specific incentive structure that deregulation had created and that federal deposit insurance had enabled. The crisis is resolved. The buildings remain, most of them occupied, some still partially vacant, all of them physical. Documentation of the specific proposition that this channel has examined across 56 case files, that the architecture of institutional failure is not metaphorical. It is concrete and steel, built on land that the market did not require, financed with deposits that the federal government insured, developed by institutions whose incentive structure made the production of unneeded commercial real estate the most rational response to the regulatory environment in which they operated. If this case file changed how you evaluate the relationship between financial deregulation, government insurance, and commercial real estate overbuilding, subscribe because the next case examines a specific development project that was financed by the same incentive structure at even greater scale. And in the comments, given the documented combination of savings and loan deregulation and maintained federal deposit insurance that produced the Sunbelt overbuilding, what specific regulatory mechanism would have most effectively prevented the incentive structure that the crisis documents without eliminating the competitive benefits of financial deregulation? This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication. Factual claims, interpretive framing, creative direction, and final content decisions reflect human judgment throughout. This disclosure is provided in accordance with platform transparency standards for AI-assisted content.